Hello and welcome to the Fibonacci free video for Friday, July 28th. This is David, and hey, I want to walk through yesterday's action in the S&P 500 because it gave a good clue to today's recovery. As we often talk about, Fibonacci informs our Elliott wave informs our Fibonacci, and I want to walk through the decline from yesterday's high up here to yesterday's low and show you how this was a picture perfect 5-wave move. And being so picture perfect, why there was a good reason to expect today's advance. And this is stuff that can be used over and over again, right? So after an initial leg down from yesterday's high into the wave 1 label, we had a bounce that was almost a perfect 61.8% retrace of the wave 1. And those are proportions that are often associated with a wave 2. Of course, any fib retracement is suitable for a second wave. It could be 61.8, it could be 50, it could be 38.2. It could sometimes be 78.6 if it's very deep. But then look at the next leg down. The wave 3, again, we've got a fib proportion. Third waves relative to first waves are generally longer and stronger. I look for something that is, sometimes 161.8, but when they're relatively long, 261.8% is a reasonable proportion. And then we look for several proportions in a wave 4 relative to when we view it relative to a wave 3, sometimes we look for a 23.6, particularly when a wave 3 is quite long. We also look for a wave 4 relative to a wave 3 to be 38.2%. In this case, you can see that the bounce ended at the 23.6% retracement of just this move down from the wave 2 high to the wave 3 low, but it was also a bounce that was pretty much the same size as this wave 2 bounce, which is another very typical proportion. And then we also have a few different ways that we can look at wave 5. One way is simply to look at it relative to the preceding wave 4, right? That's where we want to look for a move down that goes sometimes 127.2%, sometimes 161.8% of the preceding wave 4. And when we put those levels on the chart, you can see we came through the 127.2 to the 161.8%, right? That's just the external retracement where we measure this move up and then see that this move down was 161.8% of its length. But again, this is a spot where, once again, we can look for multiple proportions. And another thing that we look at is a wave 1 that, or a wave 5 that is equal in length to wave 1. And so we were able to identify this as a cluster of potential support where the move down might end even before we turn down, because both of those levels were at the right or at the same spot that let us prefer the 161.8 to the 127.2% external retracement. And we identified this in the Fibonacci chat room as a place to watch for support for a turn back up. And because we also got at least a little bit of a bounce at the end of the day, that helped confirm the idea that this move down had likely done enough and completed a 5-wave decline. Now, there are several ways from the Elliott wave perspective that a 5-wave decline could fit into this price movement. Some will lead to a turn back up to new highs. Some will just have a counter trend bounce and then roll back over. and it's still unclear which is unfolding, but being able to identify a plausible spot for the end of this move down gave a great way to figure out where we might turn back up from, right? And get involved for the bounce and have some exposure if it keeps going, and take some profit if it's going to roll back over. So I hope you found this useful, and I will see you at the next update. Hey, David here with Simpler Trading. Thanks for taking a few minutes to watch this video. I hope you found it useful. And if you did, please help us out. Click the like button. You can also add your comments below. We love to read those and respond to them. You can also click the bell icon. That will alert you whenever we have new and updated videos. And if you want to watch us trade in real time with our own money, you can visit simplertrading.com to learn how to sign up. Until I see you again, as always, good trading, and we'll see you at the next video.